The S&P 500 is officially in correction territory. The index has fallen 10% from its peak on February 19, 2025. This decline translates to a significant loss in market value, approximately $5 trillion. This correction is the first in over a year, highlighting the shift in market dynamics. The Dow Jones Industrial Average is also feeling the pressure, down 9.4% from its recent high. The Nasdaq Composite, heavily weighted towards technology stocks, entered correction territory on March 6, 2025. It is currently down over 14%. This widespread decline across major indices reflects a broader market sentiment shift. Investors are grappling with a confluence of factors contributing to the downturn. Understanding these factors is crucial for navigating the current market environment and positioning for what lies ahead. Several factors have contributed to the S&P 500's correction, creating a complex and challenging environment for investors to navigate. Rising inflation is a key concern, as it erodes purchasing power and can lead to higher costs for businesses and consumers alike. The Consumer Price Index data, while showing a slower than expected rise in February 2025, remains elevated, indicating persistent inflationary pressures in the economy. This persistent inflation has fueled expectations of aggressive interest rate hikes by the Federal Reserve, which aims to curb inflation by tightening monetary policy. The upcoming FOMC meeting is therefore critical, as investors and analysts will be looking for clear guidance on the future path of interest rates. The market will be watching closely for any signals about the pace and extent of future rate increases, which could significantly impact market sentiment and investment strategies. Adding to these concerns are geopolitical tensions and their potential impact on economic growth, as conflicts and uncertainties can disrupt global trade and investment flows. Trade disputes, particularly new tariffs, have created uncertainty and dampened risk appetite, making investors more cautious about their investment decisions. The combination of these factors has created a challenging environment for investors, who must navigate a landscape filled with risks and uncertainties. The market is currently caught between fears of inflation and concerns about economic slowdown, creating a delicate balance that investors must carefully manage. This uncertainty is reflected in the flight to safety, with investors seeking refuge in assets like U.S. Treasuries, gold, and the Japanese yen, which are traditionally seen as safe havens during times of market turbulence. From a technical perspective, the S&P 500 is flashing warning signs. The index is currently trading below both its 50-day and 200-day moving averages, a bearish signal. Furthermore, the index has fallen below the 50% and 61.8% Fibonacci retracement levels. Closing below these levels could signal further downside potential. The appearance of hammer candles on the chart suggests attempts at a recovery, but also reveals a failure to sustain upward momentum. This indicates continued selling pressure and potential for further declines. The Cboe Volatility Index, a measure of market fear, has spiked to a 7-month high. This surge in volatility underscores the heightened uncertainty and potential for large price swings in either direction. Investor sentiment has taken a sharp turn towards negativity. The AAAD Sentiment Survey reveals a 2-year low in investor confidence. Institutions are also adjusting their positions, reducing equity allocations and moving towards a more defensive stance. This institutional selling pressure further contributes to the market's decline. Despite some positive economic indicators, such as the slower-than-expected CPI growth in February, the overall sentiment remains cautious. Investors are hesitant to jump back into the market amid lingering uncertainties. The combination of technical weakness and negative sentiment creates a challenging environment for bullish investors. It suggests that the market may not have reached its bottom yet. The coming days and weeks will be crucial in determining the market's next move. Section 5. Fed Focus. Awaiting policy signals. All eyes are now on the upcoming Federal Reserve meeting. The Fed's policy decisions and commentary will be crucial in shaping market direction. Investors are eager to gauge the Fed's stance on inflation and its plans for interest rate hikes. A more hawkish approach, signaling aggressive rate increases, could exacerbate the market's decline. Conversely, a more dovish stance, emphasizing a gradual approach to rate hikes, could provide some relief and potentially stem the selling pressure. The market will be closely analyzing the Fed's statements and economic projections for any clues about future policy moves. The outcome of the Fed meeting will likely have a significant impact on investor sentiment and market volatility in the near term. Section 6. Trade Setup 1. Shorting the rejection zone. Given the current market weakness, one potential trading strategy is to short the rejection zone. This strategy involves selling short when the price of the S&P 500 fails to break above key resistance levels. These resistance levels are identified by analyzing previous price action and technical indicators. Look for areas where the index has struggled to move higher in the past, such as previous highs or near key moving averages. When the price rallies but fails to break above these resistance levels, it indicates that sellers are still in control. This creates an opportunity to enter a short position, betting on further downside movement. It's crucial to manage risk carefully when shorting. Set a predetermined stop-loss order to limit potential losses if the trade moves against you. Section 7. Trade Setup 2. Buying the dip strategically. While the current market environment is challenging, it also presents opportunities for long-term investors. One such opportunity is buying the dip, which involves purchasing assets when their prices have experienced a significant decline. However, it's crucial to be selective when buying the dip. Focus on high-quality companies with strong fundamentals that have been caught up in the broader market sell-off. Look for stocks that have shown relative strength during the downturn, meaning they have fallen less than the overall market. These stocks may be poised for a stronger rebound when market sentiment improves. It's essential to have a long-term investment horizon when buying the dip. Market recoveries can take time, and patience is key to realizing potential gains. Section 8. Trade Setup 3. Harnessing volatility with options. The surge in market volatility presents numerous opportunities for traders to utilize various options strategies. These strategies can be tailored to different market conditions, allowing traders to navigate through the ups and downs with more confidence. Options contracts provide leverage and allow traders to profit from both rising and falling markets. This dual capability makes options a versatile tool in a trader's arsenal, enabling them to adapt to changing market dynamics. One strategy to consider is selling covered call options. This approach can generate additional income from the stocks you already own, making it a popular choice among conservative investors. This involves selling call options against shares of stock that you already own. By doing so, you can earn premium income, which can be a steady source of revenue. By selling covered calls, you collect premium income which can help offset potential losses if the stock price declines. This strategy can be particularly useful in a sideways or slightly bearish market. However, it's important to note that this strategy limits potential upside if the stock price rises significantly. You may miss out on substantial gains if the stock experiences a sharp increase. Another option is to buy put options. This strategy can serve as a form of insurance for your portfolio, providing a safety net in volatile markets. Put options give the buyer the right but not the obligation to sell an asset at a specific price on or before a certain date. This flexibility can be advantageous in uncertain market conditions. Buying puts can be a way to profit from a decline in the market or to hedge against potential losses in your portfolio. This strategy can be particularly effective during market downturns or periods of high uncertainty. It's crucial to have a thorough understanding of options trading before implementing these strategies. Education and practice are key to mastering the complexities of options. Options involve significant risk and are not suitable for all investors. Always consult with a financial advisor to ensure that options trading aligns with your investment goals and risk tolerance. Section 9. Navigating the path ahead. Proceed with caution. The current market environment remains uncertain, with many variables at play. Investors are facing a landscape filled with volatility and unpredictability. The S&P 500's correction serves as a stark reminder that markets do not move in a straight line. Historical data shows that corrections are a natural part of market cycles. Investors should exercise caution and avoid making impulsive decisions based on short-term market fluctuations. Emotional reactions can often lead to costly mistakes. It's essential to have a well-defined investment plan and to stick to it. A solid strategy can help navigate through turbulent times and keep you focused on long-term goals. Focus on managing risk and protecting your capital. Implementing risk management strategies can safeguard your investments from significant losses. Consider diversifying your portfolio across different asset classes to reduce overall risk. Diversification can provide a buffer against market volatility. Stay informed about market developments and economic indicators. Keeping up to date with the latest information can help you make more informed decisions. Pay close attention to the upcoming Fed meeting and its potential impact on market direction. The decisions made by the Federal Reserve can have significant implications for the market. Remember that market corrections can create opportunities for long-term investors. These periods can offer the chance to buy quality assets at lower prices. By remaining disciplined, managing risk, and making informed decisions, investors can navigate these challenging times and position themselves for future success. Discipline and patience are key. For more in-depth analysis and real-time trade insights, subscribe to our newsletter and stay ahead of the curve. Our experts provide valuable information to help you make the best investment choices.